Yeah, I was there with I'm looking forward to it. Yeah. I'll bring my music. Because I can make it. I think the market. I think
Good morning. Welcome. I know most everybody here, so I'm not going to do a big introduction on our firm, and I don't think we have anybody online just yet, but hopefully they'll be joining us soon. We are very excited about our program today on business succession planning and executive benefit plans funded with corporate-owned life insurance. I've attended this program at another venue previously and was very well received and with a lot of Q&A. Hunter Ewing, president of Ewing & Company, and Justin Gladio, regional VP with Nationwide Life Insurance, will be our speakers today. Hunter and Justin will explain the different COLI products, the benefits, and how to use them in planning for succession and liquidity events. Hunter began his career in the life insurance industry with Northwest Mutual prior to founding his own firm, Ewing & Company. He was a partner also with a specialty insurance firm previously. An active participant in industry organizations, Hunter is a committee chair of the Association for Advanced Life Underwriting in Washington, D.C., and a board member of the Atlanta Estate Planning Council. Hunter specializes in insurance strategies for owners and executives of privately and publicly held businesses. And he's been a good friend to the firm, and we're glad that we have some of our brokers here in attendance, because this is something from a trend standpoint that is going to be more and more prominent as the next couple of decades unfold, and with all the baby boomers aging out of ownership and needing to find a way to transfer that ownership to the next generation. As a regional vice president for Nationwide Business Solutions Group, Justin Gladio has become a proven sales professional in the multi-life and executive benefit space. Justin's career in the financial services industry has given him expertise in life insurance, non-qualified deferred comp plans, corporate-owned life insurance, executive benefit plan designs, and bank-owned life insurance. Justin is a certified exit planning advisor and a member of the Exit Planning Institute. Please welcome Justin and Hunter.
Thanks, Doug. I guess you all can. I never know how close to sort of put these things to your mouth, so I guess if that's okay. But initially, let me thank you, Doug, for having us. You mentioned our partnership. We are very, very appreciative of that and appreciative of the chance to be here. And thank you to all the Sterling Seacrest partners that are here. We really appreciate you coming, and to the Sterling clients and folks that you all work with. So we really appreciate the hospitality. Also, real quickly, just want to thank Justin Gladio with Nationwide. Nationwide, as you guys are going to see, is really the leader in the corporate-owned life insurance market space. And so we appreciate our partnership very much with you and your company. Y'all do a great job. We've had a lot of success with you. I want to say hello to a couple of friends that are here. Tim Sheehan with BNY Mellon, and Bert Mills down at the end of the table, who's managing partner at Moore Colson, also great partners of ours. So here's what we're going to do today, and here's how we... Bert. That's right. That's right. I shouldn't leave that out. Poster child back there, the poster boy. In fact, I want to get a picture with you before this is over. Just so, I want to post it on my Instagram. So like, I am someone. I'll give you $10 if you sign it. How about that? All right. So here's what we'd like to do today. Justin and I are going to sort of dog and pony a little bit. I'm going to sort of play the role of seeing a lot of these types of things in the marketplace and helping you guys really think about the uses of insurance here on a practical level. Justin is really more going to speak on some of the technical points of what we're going to talk about. And I think as Tyler and I were driving over today, the first thing I want to establish with everyone is that this is not your typical life insurance policy. This is not, your grandparents' whole life insurance policy or term insurance policy that a lot of people typically think of. These are very specifically, uniquely, institutionally priced and designed life insurance policies. They are the types of life insurance policies that if you look on the financial reports of our friends across the highway at Home Depot, or the big beverage company down off North Avenue, or the big banks, you will see billions of dollars literally of cash value life insurance on those companies' financial statements. And the reason you see it is because of the fact that these types of life insurance policies have some very specific tax and planning advantages for businesses. So what's happened over the last, I think, Justin, really the last decade, is that those types of products that have been used at that corporate level that I described a second ago, have been used forever, have been scaled and down, if you will, to smaller business use. And so those very same kind of products that pass muster with the Coca-Cola CFO are now also very attractive for closely held businesses, the types of businesses that we all work with every day. So the key point again that I would make to you is I don't want you to think about this as with some of the typical preconceptions about life insurance, because this is a different breed. It's very efficient. Fair enough?
Yeah, the only thing I would add to that is, as you said, it's an institutional asset class, and that's exactly the way it's positioned. It's not available for sale on a retail basis. You can't go out and sell this just an individual. It has to be used in a business setting. Nationwide's been in this space for 20 years, and when we first started 20 years ago, the only thing we did sell this product to publicly traded companies to offset their deferred comp plans, and we sold it to banks from a balance sheet as holding company. Nationwide is the overall market leader in this space. We have been for the last 7 years in a row. But what we did about 7 years ago, transitioned our mindset and looked at the kind of the landscape that was coming. Closely held businesses looking at transition and need for life insurance on the balance sheet of closely held companies, and we created a team to go downstream. That's my job. I work with everyone else. So instead of just publicly traded banks, we work with S corps, LLCs, private companies. We do a lot more than just holding deferred comp down, even buy sells, we do any type of succession or transition thing. So it really has come full front over the last about 7 years, I would say. Yeah. So, and that's what we're going to talk about today, is how this is a strategy for everyone now, when it used to just be a strategy for the big players.
Let me give you one example of that real quickly, and then we'll jump into it, and we'll be sensitive to time. But when most people think about a permanent life insurance policy, they've seen whole life insurance policies from my predecessor firm, Northwestern. You sort of see them on paper, and you put in $1, let's say, and the cash value component of those policies may have 30 cents day one. So you go like, okay, where'd my 70 cents go? Well, if you're the CFO at Coca-Cola, you ain't buying that. That's not going to work. And so at the end of the day, what you will see in these types of contracts is if I put in $1, I got more than $1 day one. I've got typically $1.03. So they're designed to be balance sheet and financial statement attractive is a key point. So that's one example of how these things are different. So let me turn the page. Katie, I may have to ask you how to.
There we go.
Okay, thank you. So as a quick segue, there are just some interesting statistics that you guys should know. There's a huge amount of business transition and succession that's going to happen in the next decade. Not supposedly, that's the wrong word, but according to y'all statistics, $10 trillion in terms of your market studies of business value is going to transition over the next decade. It's a big, big deal. Family-based business transitions that we work a lot in, closely held business transitions to strategic buyers, private equity. Doug, you and I have talked a lot about ESOPs. We had a meeting on ESOPs recently that Justin was involved in. So there is a tremendous amount of business succession, and I think we're all seeing that. We definitely see it in our business.
Absolutely, yeah. And I think, you know, as you guys, as individuals in the industry and then also advisors to clients, these things are happening. It's going to happen. And it's whether or not the people are doing the proper planning for these events, or they're not. So a lot of times people come to Nationwide and they say, I'm 63 years old, I'm going to sell my business in 2 years, can you help me? The answer is, well, yeah, we can help you, but you probably should have started 5 or 10 years ago. A lot of these transactions, like Hunter said, family-based, you know, that's just from one generation to the next. A lot of what we're seeing is, unfortunately, people get to that point in their careers where they are at the point where they're ready to go, and they haven't done planning. The only option is private equity. We probably all have seen private equity in our lives in one way or another. That's not necessarily a good thing. Yes, it is an exit strategy. It's a way for people to get out. But me as an insurance professional and you as an advisor or you as a client, one, you're probably going to get a low valuation. And two, if you have a relationship with a client and they sell to private equity, I can guarantee you can kiss that relationship goodbye. Because they do not care about the framework or the fabric of that company or really the long-term intent of that company. All they care is about the metrics. So I would say that as a cautionary measure is if you have clients and you're advising them on what you want to do in the next 5 or 10 years, don't let them wait to the last minute and be subject to private equity. I'm not going to sit here and say private equity is the devil, but there's a lot of other options on other things that should be on the table.
I would just add that you should, even though it's not what we do specifically, we should be asking about this, because if they tell you about it at some point, it could already be done. And your relationship that you spent years building is probably over too.
Yeah, that's right. Because somebody gains the trust, you know, having brought up the issue. One thing I would add to that real quickly is that Nationwide is unique in this sense as a partner of ours with your ability to perform a lot of analysis, internal analysis, valuation work, Bert, that's very helpful in relation to the valuation work that you guys can do. So there are opportunities to work together in that respect. And one of the things that we do together are insurance reviews. Tim, I hear you use the terminology a lot about y'all's work as a risk audit. When you review a client's investment portfolio, we do the same thing on the insurance side, and that's very helpful because most companies already do have some type of insurance, and those kind of reviews are very, very helpful.
Yeah.
So, needless to say, and then we'll segue to the next section. Needless to say, you know, the untimely passing of a business owner or a key executive can have a huge impact on a business. I can tell you from personal experience, my uncle had a company. He died at age 48 of sleep apnea. And they had just gotten the telephone contract for Disney World, I kid you not, in Orlando. He passes away. His minority partner has got my aunt over you know what, and he buys her out because the buy-sell agreement and the insurance was not there. He buys her out for pennies on the dollar, and the guy is probably on a yacht somewhere.
Yep.
So it's a true story. So that's really important to think about.
Yeah,
so
just to touch on that real quick, the planning is a must. So Nationwide has business valuation tools. We do plan document review. We've essentially built a team inside of our operation that will handle all of that for our clients. So I'm not just a product guy. We take a consultative approach to every client that we work with because from our standpoint, it's all about retention as well. So if we do this the right way, we do it for the right way for our clients, we know they're going to be clients of Nationwide forever. So we're not just out there pushing product. We're working with advisors like Hunter. We're making sure that this is done properly. That's our value proposition.
Jess, I'm going to let you keep going on really sort of what is COLI. This is where we're going to sort of dig into the heart of the matter and really give a technical.
Really, you want to talk about, yes, succession planning is a need, and all these things are all going to come. But really, ultimately, you know, today we're going to talk about what is corporate life insurance. And really, corporate life insurance is just an acronym for just that, corporate life insurance. And that could be anything. So that could be a term product, that could be a retail product, that could be an institutional product. And we're going to walk you through exactly what the differences are of those three so you understand that. But why do companies buy COLI, and why is it so important to companies to have on the balance sheet? Really, the most important thing is what Hunter just talked about. Think about key man coverage. If one of your most important people goes down on an untimely death, what's going to happen to your business? If they own shares in the company as well, and you have an obligation to buy them shares back, if you have no life insurance on that individual, and that event happens, how are we going to fund that monetization or that liquidity event? You're going to have to borrow money. You're going to have to potentially sell the business. So most importantly, up front, it needs to be on your key people. It needs to be on the business owners. purely for transition, purely for succession planning.
When we are become involved in working with clients in this particular area, I would say to you all that 75% of the time we get involved with a new client opportunity, they have some life insurance, they have some sort of buy-sell agreement, but I would say to you, 90% of those people that do have it, it's out of date. What I mean by that is their business has grown, their arrangements have changed, whatever has changed a lot. And so at the end of the day, it's critically important to make sure these things stay in tune and contemporary with the business itself,
Yep.
in terms of the business's need at any time.
Yep. And a lot of times you'll see corporate life insurance on someone's balance sheet because the bank, or essentially maybe even the surety company or someone from the lending facility standpoint is mandating that. So if the company borrows $10 million and they don't collateralize that line, something happens to that business owner and it's non-recourse debt, the only way the lending institution is getting their money back is through that life insurance policy. So you'll see the banks here in town, SunTrust, Regions, BB&T Wells, they will mandate this on their clients to own because of that reason as well. So we see it a lot. We're going to talk a little bit about that strategy today and how this plays into that. Executive benefits, non-qual, this is where it all started. Coca-Cola, Chick-fil-A, Home Depot, they all bought tranches of corporate life insurance to offset their deferred comp liabilities. So they had obligations to people down the road to pay them deferred compensation. And the thought process was that individual dies, we'll use the corporate life insurance to pay out that obligation. Any leftover death benefit goes back to the business and helps them cost recover the cost of that program. So that's where it all started, funding executive benefits and funding BOLI, but it's come downstream in the last about 10 years.
And I know I sound like a broken record, but just imagine using yesterday's type of life insurance policies for those types of needs. They just don't work. So it's got to be uniquely designed and different.
Yep, tax enhancement to the balance sheet. This is really kind of the BOLI world, and we also see this in the insurance company world. So insurance companies will buy big tranches of corporate life insurance to put on the balance sheet and wrap some of their investments in it. We'll literally put variable-based investments in a life insurance policy because it goes tax deferred, offers tax-free distributions, and has a tax-free death benefit. So we can take assets that are sitting there and tax inefficient today, put them in life insurance and make them more efficient. So that's a very big strategy, like I said, with banks and insurance companies. Cost recovery, there's no way to ever recover the cost of funding a deferred comp plan or giving someone an ancillary benefit. Life insurance is one of the ways you can do that. You're the key person, you're going to give them additional compensation. And the only way you're ever going to get your money back is eventually when they pass away, that benefit comes back to the business. So we see that on the large scale with these big companies. They'll be around a lot of people, and eventually when they start to pass away, here comes cost recovery for funding those programs.
But I would add to that, one of the things that we're doing more and more work in are designing strategies for closely held businesses where there may be one or more owners, and we are trying to help those businesses figure out how to buy out or pay out the owners. And at the end of the day, more and more frequently, because of these tax advantages of insurance, they're using insurance as a warehouse to put money so that they can pull money out in the future to pay people out as they leave, and then the company typically will retain the insurance, what's left over, and they'll recover costs using that. So it's a very common strategy for closely held businesses that we're doing a lot of work in more and more.
That comes kind of ties into the offset liabilities. That's kind of the generic broad-based term. You're really looking to offset some type of liability. COLI can be any type of product. We're going to run through these pretty quick here, but really, there's term products, which is probably what the most of us are used to. There's retail products, which is available to everyone, and then there's institutional. So we're going to touch on those and make sure you understand the difference.
But I agree with you. I mean, COLI is just an acronym for any kind of life insurance policy that's owned at the corporate level. And needless to say, I guess, but what we try to do is help companies figure out the best way to do it with product or whatever.
Term insurance, we're all probably aware of the term, temporary coverages, only viable during certain time periods. You pay your annual premium. You literally have no cash value, but you have coverage for that period of time. Every single year you're going to come to the table, you're going to pay that premium. After 10, 20, 30 years, you no longer have coverage. Sometimes you can convert those, but for the most part, that's done. So at that point, if you have not experienced mortality, you paid all this premium on an annual basis, you have nothing to show for it in terms of cash value, and then you got to start over. You have to go find some permanent protection, or maybe even another term policy at that point. So it's a Band-Aid, it has its place, but it's probably the most inefficient means of coverage.
But I would add to that, it absolutely has its place. I mean, we place a lot of term insurance in the corporate context. We talked about bank-related issues. We've done probably 3 projects this year for startup companies where the bank said, hey, look, if we're going to lend you $3 million, you two folks, we need to make sure that if something happens, we get our money back. Well, guess what? Their cash flow is pretty darn strapped. They're starting a business, and by golly, they need good protection. So term insurance can be a really good solution in the right spot, and we're believers in that.
Absolutely. In retail, this is, I'm going to let Hunter talk a little bit more about this because he's sold it for the longest time being Northwestern Mutual, but this is just everything else that's on the marketplace. Yes, they're permanent products, whether they be cash accumulation based or they be coverage based. A lot of advisors that are in kind of the retail space will sell retail products to corporations. Corporations do buy those because they may have never seen institutional. So kind of the same kind of thought process is term. It fits, it has its place, but it's not the most efficient means because the way those policies are typically structured. We actually replace a lot of permanent products with other carriers into Nationwide. So we'll do what we call a 1035 exchange. We'll take that old policy someone else sold them, bring it into our institutional contract, and give them access to our products. So definitely has its place, but still might impact others.
Yeah, but I would add though that this marketplace has come a long way. I mean, it really, really has as well. And at the end of the day, there are products that are very, very useful in this space, depending upon the crediting rate strategy or whatever that we want to use, that can be very, very,
very efficient as well.
So again, our job is to sort of figure out which is the right strategy in the situation.
And one of the things that I want you to take note of is the negative impact of the balance sheet. And we're going to talk through that when we get to the institutional example. But on a term basis and on a retail basis,
if a company buys this and they pay, let's say, $1,000 per term, and you have 0 cash value, what's the impact of that company? You paid $1,000, you book an asset with 0, you've lost $1,000 essentially, right? On a term basis, same thing.
On a retail basis, same thing. Anything you pay, if you have to book a value less than what you paid, that's a negative impact on earnings. That's a big deal for a company. Maybe not as an individual because you have personal protection and you understand that. On an individual basis, on a corporate basis, that can be a big deal. And that's why banks and that's why publicly traded companies would never buy a retail product. They will only buy institutional. For institutional, this is really the sizzle. This is why we're here today to talk about this.
Everything
we do is a permanent product. We don't have any term products. Adjustable premium schedules. Typically, everything we do is what we're going to call max funded, meaning we want it to be a cash accumulation-based vehicle. It's going to look and act and feel like an asset to that business. There's no surrender charges. So one of the things that makes this very popular is your clients can walk away at any time. That's really why companies started to buy it. And it's like the balance sheet, it looks and acts and feels just like a liquid investment.
Justin, if you don't mind, I don't want to take a liberty here. In these types of life insurance products, there is this thing called cash value. Most people are familiar with cash value, and that is, in my mind, kind of analogous to like equity in a house. Okay. It's like a value inside the value of the policy. Well, again, not to take a liberty here, life insurance is unique in this respect. That value is growing without taxes every year. And ultimately, that value can be accessed without paying taxes. And the death benefits of the insurance are also tax-free. So this, again, not to take liberties, I want to make sure that we sort of reinforce the fact that these things, growth in these values is occurring without taxation. That's a big deal.
Yep. You have tax-deferred growth. You have tax-free distributions. You have withdrawals and loans. You have the tax-free death benefits. So in theory, it kind of turns into a Roth IRA-like strategy for your business that has a death benefit component to it as well. You can't really get that asset class anywhere else. Yeah. Asset and corporate balance sheet, that's really one of the most important things, and we're going to show you that. Any questions or
any specific thoughts? I know, Bert, you guys see a lot of companies with insurance on the books. Yeah.
Yeah.
So we're working on that now.
Yeah.
We're trying to arrange something that it might work. We can arrange something like.
Yeah, that's a really interesting point, Bert. Here's what happens at Coca-Cola. Coca-Cola has, I don't know how many executives that are part of their plan, a bunch. But not every one of those people is necessarily insured. And the reason that every single person in that pool is not necessarily insured is because there are some folks that are older, there are some folks that have had health issues, you name it. So what they typically do in that sort of context are pick of a pool of people, sort of pick those that are the youngest and typically in the best health, because the expenses, the internal charges of the life insurance policy, guess what? Nothing is free. Life insurance has got fees associated with it, are the lowest. And so what you're referring to, Bert, is kind of a fancy word for saying it's called aggregate funding, but it's basically a way to sort of pick the best risks for lowest cost to create a big bucket of tax-favored money that can be used by the company to pay people out or whatever the case may be. That's kind of what we're talking about. Exactly. Exactly. So let's, Justin, let's go forward unless you had any other points there.
We define institution from an insurance perspective. The ones that are incorporated.
So institutional means that specific product subset. So it means if it's a product that is manufactured specifically only to be used with businesses on their balance sheet.
So any size of business. So looking at revenue protected for certain ownership structure. Or
has to be owned corporately. Can't be owned by the business owner or the key executive. So it has to be owned by the business. And it really can be, thanks again to this sort of scaling that has happened over the last decade, can really be, I don't know what the minimums are.
We at Nationwide have $100,000 case premium. So that's our minimum.
Yeah.
Yeah.
Pretty darn low.
That's fairly, I think, common in the industry.
Yeah.
People may go below that. So the reason we do that is that's to protect us. And we only want to deal with companies that are healthy, that are profitable, have significant cash flow, have the liquidity to actually do that type of purchase.
But I mean, because you guys were smart as a carrier, I think, because you said, look, there's a humongous small business market out there. Guess what? Everybody chases the big kahunas. But you guys were kind of the first to identify that the closely held business market could really benefit from this stuff. And by golly, you've scaled this stuff down and it's really working.
Yep.
It's the fastest growing part of your business, if I'm not mistaken.
Yeah. Yeah. Specifically what that translates to is a business with $5 million a year or more of revenue and $1 million of cash or cash flow. That's typically where we play. Anything less than that, we're going to be too small.
A couple of friends just walked in. Hey, Kenny.
So
hey, Mark.
To kind of drill down a little bit more about, we just talked about the merits of the product. I mean, life insurance is a corporate asset. And really the applicability here is the fact that the next day you've got an asset that has a positive charge to earnings. It doesn't have a detrimental or intrusive impact to your balance sheet. It's safe and conservative. That's why banks buy it. We're going to show you why the company that Hunters did this year is why they bought it. Full liquidity, you have access to it. So it's that same T+3 transaction time that SunTrust, Wells Fargo, all those guys are going to have on an institutional basis. We have
That same provision. And the reason we have that
same provision is those publicly traded companies said if we need access to these dollars, we have to have them in the same time frame we have our other investments. So that exists in Nationwide for that reason.
tax-deferred growth, tax-free distributions, tax-free death benefit.
That's that IRA tax strategy leverage to death benefit. Portability upon retirement. So this is a big deal for us. One of the things we do is when we work with business owners, and as Hunter talks about, typically it's
Owned on the balance sheet of the company.
the ways to get it off, it typically run the balance sheet of the company. But if
Someone looks
to sell their company in 5 or 10 years, they say, Justin, I put all this money into this asset class. I don't want to leave it on the company's balance sheet when I go. Can I take it with me? The answer is yes. So we can change the ownership
from the business.
to the individual.
But it has to originate at the business level.
Correct.
Yeah,
Correct.
it's got to start at the
So
business level.
let's say they
See that private equity transaction.
life insurance on the balance sheet, instead of giving it
To the private equity,
company, part of the valuation, they can take it.
that's a big deal for us. We do a lot of that.
Planning where it's coming off the business.
Yeah, which is that in and of itself is a great thing. We will work with and start working with prospects that have got sort of legacy insurance that they had originally from running a company or, a key executive, a senior level executive at a publicly traded company. It's very common and a great thing. Great thing because sometimes they may not have any other insurance options. So
Now it becomes part of their overall individual planning. Probably one of the most important things, we're going to talk about this in an example, is
Collateral.
used for surety.
Used for asset-based lines. It's used for any other banking, lending, mandate.
Any type of ratio that a company may have today, this is not going to negatively impact. Actually, probably going to make it better. The bank will look at that, they'll view that dollar for dollar, they'll take that life insurance as collateral, so it's something that you can go in there and say, you see your assets today, they're being held for surety, they're being held for assets.
Lines, let us help you leverage that and actually create a positive leverage around that compared to it just being
A line item that's sitting there for those mandates.
Can I interrupt for a second? I mean, I don't know,
your specialty, you're the guru of surety around this part of the world.
Something unique about using security is that, like, the only asset CPAs don't consider current, right? But the surety actually moves it above the line and says, we consider this current. So that's how strongly they are aware that it can be converted to cash. So it's unique in that perspective. Typically, the adjustments on surety balance sheet analysis are going from current, non-current, less liquid. This is the one exception to that rule, and we have lots of contractors who sit on their books and fully 100% credited for work.
If you don't mind, I might tell two quick stories to add to that, Doug. We have a company that we're working with here in town that has a lot of existing insurance they've had for a long time. We're helping them sort of review that and determine if it's the right or wrong thing to keep in terms of other products in the market. But that insurance is a construction company. It's the biggest asset on their books. It's absolutely critical for their bonding. They wouldn't, they've used it. It supports their bonding program. They've borrowed against it in times past. It's been the most valuable asset on their books. They're a construction company. So it really, and the other thing is, I was saying that I'm going to share a case study with you all in a second that we were fortunate enough to work with Doug and Bert and actually Kenny on. But the thing for most companies is if they hold in cash, and a lot of construction companies hold cash, they're getting whatever anybody else gets on cash, right? Not much of a return on cash. Well, believe it or not, you can sort of take that cash and redeploy some of that cash into the life insurance structure. You get the benefits that Doug just referred to, but by the way, you're also getting insurance with it. So you're getting a positive impact financially, but you're also getting insurance to protect the owners, which is what we did. So I'll share that in a second, but keep going.
Yeah, so I will tell you, one of the things that makes us unique is not only do we sell solely bank-owned life insurance to banks. Of the 4 clients we listed here, three of them have policies
with us. A lot of those over $1 billion. But
one of the things these banks do
is based
upon their relationships
with their clients, they will
go out and they will sell this contract and this opportunity to their clients because they know they have assets.
They know they have their share.
They know they have their lines, and they're going to go out and they're going to give them a more efficient use of that capital, and they're going to collect the revenue off that transaction. So not only do the banks buy it for their own balance sheets, they will sell to the clients and will collect that transaction.
But if you see a bank trying to sell insurance to the client, which we see.
They're not the most sophisticated.
Yeah.
So that's where 100 is.
Right. Thank you.
One of the most important things is GAAP tells you exactly where to put it. You put it as a non-current asset, so it goes one line on down. And as Doug mentioned, a lot of people will take that and they'll move it up, but they'll take a dollar for dollar integration.
A lot of technical stuff there, but any thoughts in particular?
So that's the liquidity provision. So if you call Nationwide and you say, someone calling our surety line, we're getting sued, we need a cash crunch, whatever that is, we will either surrender those policies in their entirety, or we can take a loan or a withdrawal against that cash value, and we will have that to you within 3 days, no questions asked. So liquidity provisions are just like if you called the bank and said, hey, I need money.
no surrender charges, you know, just, and a lot of the retail products do have sort of a phase in time where it has to grow, but these again don't have that. I mentioned to you all that we really had such a great experience this year working with a company here in town, a construction company, client of Doug's, clients of yours, Bert. Kenny, you know these guys. Just a quick example, construction company, 2 primary shareholders. I can't remember if it was 7, but I think there were 5 to 7 smaller sort of shareholders now. The company has always maintained about $5 million of cash on their books, really for the purpose of surety bonding. We got involved in the conversation to say that, and Doug, you were good enough to help us co-host an event where one of the owners attended a few years ago, and he sort of looked at it and said, you know, we've got some cash on the books, and wow, it's interesting. You're telling me I can get a little bit more credit on this cash if I just move it over here. And by the way, we're already buying term insurance to protect myself and my partner here, and we're spending, I can't remember what it was, $30-some-odd thousand a year for term insurance, which was sort of sunk funds. And so with your help and with your help, Bert, and yours, Justin, and we really began a pretty in-depth analysis of sort of how this could potentially benefit the company, as $40,000 of term insurance. So what we decided to do, and what they decided to do, was to think about it as just a reallocation of some cash on their books, moving cash from the cash account to this life insurance policy account. We show you some actual values here in that transaction. And what they decided to do was redeploy $2 million of their $5 million of cash into these policies that insure the 2 principal shareholders, deploying it over, allocating $400,000 5 times. There's some tax reasons why we don't put it all in at one time. And so at the end of the day, but what you can see is that they won. They had a positive impact to their cash. And not only that, but the combined amount of insurance, which we split evenly between the 2 partners, was $5.3 million. So day one, they're actually better off for moving cash that is just as liquid, just as available, but now receiving better credit, qualifies, still good for surety bonding purposes, and gives them the insurance. And by the way, they're getting a positive impact on cash, and they don't have to pay that out anymore. Not a huge amount of money, but every dollar counts.
Absolutely.
So just a great success. Terrific, guys. Thank you again for your help. Bert, yours as well.
Great to work with. So one of the things is, you know, we're talking about retail. If you did this same transaction on a retail basis for the retail product, let's say you use Nationwide's retail product, you put $400,000 in, the end of year 1 cash surrender value would probably be about $200,000. You're in a situation where you gave Nationwide $400,000, but you're only booking half of that. You have to put that $200,000 on your balance sheet. So now, from an accounting standpoint, the difference in the delta between those two, the negative impact to your bond. So that's the most important thing, is people ask, well, what the sizzle is. Well, do this comparison of a retail product to a term product and see the negative impact and what that creates. That's the most important thing. And that's the cash surrender value at the end of the first year. That looks and acts and feels exactly like what it is. That death benefit, that $5.3 million in the event someone dies, Nationwide's paying that back to business.
One of the things I would add too is interesting. It doesn't show up on this page, but this was true in this case, and is often the case. You know, from an underwriting perspective, Doug, you guys are very familiar with how this works. From an underwriting perspective, folks that own closely held businesses, you all in the audience, you know, you do things that just with your spare time that a lot of people don't do, and travels or you know, charitable work, you name it. And so you all are used to underwriting folks that do different things.
Yeah, high net worth approach.
Yeah, I mean, high net worth folks just, you know, they travel more and do all sorts of stuff, and so you all are used to working with that pool of folks, and at the end of the day, really have some critical understanding and underwriting advantages when it comes to that. We are able to work with you all to get pricing that on a comparative risk basis we might not get at the retail level. Just because, again, you're used to that pool of people. And it's sort of built into your, what's that?
To clarify, that's all the reinsurance.
Yeah.
In our pool.
All right. So you're used to that group. So, yeah.
We did that strategically, and the reason was is when you get to year 8, we do what we call a corridor reduction, which is bringing down the difference in death benefit and cash value. The only reason they wanted to see that is that helps the cash value continue to grow the most efficient level. So they could, in theory, have left the death benefit where it was.
Yeah.
But that IRR would have had a little bit of drag.
In fact, in this particular case, we've proposing that as a possibility. Maybe, down the road, it's not something that's structured into the product, Doug. It's something that is done on purpose at the time to reduce those expenses. But we talked, and they may maintain it depending upon sort of Bert, where they are in the business and so on and so forth.
One of the other things we discussed is they would have the ability to pay premiums in year 6 and 7.
Oh, yeah.
And when
That's a great point.
That point down the road, they were going to make that decision.
Yeah, that's true. That's right. Yeah.
If they did, then they would never have to drop the rate.
That's right.
Yeah.
So this is the model, subject to change, very flexible, based upon what they want to do.
Yeah, do not. One-time underwriting. Now, if they wanted additional coverage, then the answer is yes. But when we do a reduction or they want to pay more premium.
Guaranteed UL.
So this is, it's a current assumption UL. The crediting rate on that is 3.85. That's nationwide safe, conservative institutional product. It's tied to the general account inside of our division, not the overall nationwide pool. And that rate is highly competitive, as you can tell. And we are very diligent and cognizant as to when and if we move that rate. We're always in competition with money markets, CDs, low duration portfolios. So this is a true institutional rate. Can't get that anywhere.
It's a great point, though, because I think you're getting on something that that is one way to credit value to a policy. This, what I always refer to as the fixed account of an insurance company, the big bond-like account. There are other options. You guys also will use, going to the kind of the other side of the spectrum, you'll use what's called a variable contract, where you make available, 100 things that are essentially mutual funds. They're technically called separate accounts, but companies like those, Bert, you're familiar with this, where someone wants to have something that looks a lot like a 401k, right? They want to have sort of that manageability. And then one of the things that we're really pushing you guys to come out with, and hope you will soon, will be sort of the middle of the road crediting strategy, typically referred to as index universal life, where the companies have a floor and a cap, which we also, by the way, really like a lot in this market, and we use quite a bit. So hopefully, I think you said y'all are working on that. But it's a great question about the crediting rate. Great question.
So this truly is a conservative way. I mean, this is that asset repositioning for cash alternatives. Probably wouldn't come to us and say, hey, we want to use your variable product for this item. Kind of truly what we call money market alternative.
And the bonders wouldn't use a separate account product. It really needs to be a portfolio type product. Exactly. So
that was, we started really initially talking about succession planning with business owners, not to kind of downplay everything else we do, but we work with companies that want to recruit, reward, and retain their key people. So if it's something outside of the business owners, a lot of times Hunter can attest to this. The
transaction starts with the business owner, and then he says,
well, I want to do this for my key people. So I want to do this for another layer of management. So that's what we do as well. We're seeing a huge uptick in non-qualified deferred comp, supplemental executive retirement programs, where those golden handcuff opportunities. We've run on 9 years of economic expansion. I'm sure everybody and their brother gets a call from a recruiter once a week about a new opportunity. So these are things that companies are really coming to us and saying, hey, I need something to help recruit, reward, and retain these key people. Each of these programs is they're very flexible. You can be discriminatory. You don't have to do it for everyone. You can do it just for a select group. So when you come to Nationwide and you say, hey, this is what we want to do, we can pretty much almost always give you exactly what you're looking for. Now, there's some rules and regulations, but we have flexibility there in the form.
We have a client that's very, very successful, very, very profitable, with one shareholder. compete in a competitive environment for people, and they built a program like this. They clip vested it to the back end. You had to stay for the 10 years that you're committed to really get the value for your buck. But they can see the accounts building up. It's been super successful for them without giving them equity.
Yeah, sometimes a plan like that maybe we refer to as phantom stock. You know, they want to make something look a lot like stock, and it's a great way to do it. Who has heard the term deferred comp? I always find there's a lot of, you know, confusion about what deferred comp is. I'll take 2 seconds just to explain deferred comp. Deferred comp in the classic sense is Kenny, who makes $1 million a year, says, you know what? Says, hey, you know, I don't need $1 million a year. And by the way, I'm getting taxed like crazy. All I really need is about, you know, given your fancy lifestyle, $750. And, you know, take the $250. Don't pay it to me. You keep it, employer. I'm getting taxed on $750. They kept the $250. And there is an agreement that you have that you will have with that employer, Kenny, and they're saying, okay, pay me that down the road. Now, technically, so you're deferring the comp, right? Now, technically, the company, and there's some IRS stuff around this, but technically the company is not obligated to sort of take that money and put it somewhere. It can be just a treasury obligation. And rarely, but sometimes that happens. You don't feel real good about that because you're sort of an unsecured creditor of the company down the road, right? Well, most of the time that you guys enter into that deal together, they take the $250 that they were going to pay you, and they put it in this pot. And this pot, most of the time, about 80% of the time, statistically, goes into these kind of life insurance policies. Sometimes companies will just use traditional investments, but more times than not, they use this stuff because it's growing without tax. If the person passes away, you guys have had some sort of agreement in your deal that said, if I die early, my family's getting this. And at the end of the day, when it comes time to pay you $250, you wanted to have some appreciation of that. You got that. And they go to those life insurance policy buckets and take the $250 out with appreciation, tax-free, and then pay you. So they get the write-off on the pay that and you got to take it as income at that time. But that's the classic definition of deferred comp. Sometimes a company will say, to your point, Doug, hey, Kenny, you know, great, and we love you so much. If you put in $250, we're going to add another $100. So it can be employee and employer contributed. Every plan is different, but the beautiful thing about these strategies is they're totally flexible. So you don't have to do them for everybody in the company like a qualified plan. Fancy language for this is called non-qualified benefits, but they're great products, and most of the time, these types of products are used in that context. So, and the great thing, again, from my perspective, having done this for 25 years, 10 years, 15 years ago, you wouldn't even have this conversation with a small company because there just wasn't anything available to them. But now, the sky's the limit. It's awesome.
Yep, we're doing a lot of looking at and feel like pension programs. You know, you don't see a lot of pension plans anymore, but we can create essentially a deferred comp type strategy that the company contributes money to. That money will grow tax deferred whenever you leave. You take a receipt of those dollars. So it can look and act and feel just like a defined benefit or defined contribution pension plan. We're seeing a lot of those. We also do what we call LTIPs, long-term incentive programs, where that's really just a fancy name for a profit sharing program, which you get your selected with management employees. So as Hunter said, and you talked about, there's a lot of flexibility there, but we are seeing a huge need and demand for ways to retain and recruit people. We can help you figure out how to. The question I always ask my business owners are, who are you most afraid of losing, and what would that do to your business? Whether that person voluntarily walked out the door and went to work for one of your competitors and you're non-compete stuff, or is it because that individual passed away? So you should be asking your clients and your partners those questions.
Great point. Any thoughts on any of that? Do you guys see those types of plans in the market, or? Okay. Yeah.
Just important ability. That question there, what happens if they turn stable?
Absolutely.
Boy, what a great point.
Yep.
I mean, a great point.
Yep.
Shame on us for not bringing that up. But Yeah, that's absolutely a huge issue. And although you guys don't do it,
We don't do it personally, and that's the
Yeah.
only reason we don't talk about that strategy, but absolutely, we see a lot of plans where they kind of marry those. You know, someone will do a good BI and they accomplish. Absolutely.
and generally we can, through some specialty arrangements that we have access to, get really large amounts of disability insurance structured different ways. I mean, a lump sum buyout, lump sum payout, a staged sort of installment payout structure in a disability plan for a key executive or business owner. Lloyd's, as you can imagine, is a dominant player there. And anyway, but terribly important, you know, and statistically more important from a risk standpoint in the short run before age 65. Yeah, so thank you for bringing that up. So I think we covered most of those points. But again, I think where we would hope to be able to help you all and your clients and the clients in the room or on the call is that we are perfectly capable and really experienced at everything in relation to the concepts and designs using these strategies. You guys do a terrific job internally with assistance on valuations. It's where you can add a lot of support to folks like Bert and his team. I'll let you talk a bit more about that.
We built the valuation software.
A lot of times people were bringing clients to us and they said, well, I need $20 million coverage. Why do you need $20 million coverage? Because that's what I think my business is worth. Well, how do you know that? Well, it's just a number I have in my head. So we built valuation software specifically so when our advisors are going out and work with their clients, they have a starting point or starting mentality as to what that business is worth and their insurable interest.
Back score, but really just a conversation piece that we started. Along with that, we have boilerplate templates for buy-sell agreements, for compensation plans, all the search
Programs, exact bonus.
anything you would ever need, we can help you with the actual mechanics and design of those programs and give the documents.
That's a great value add, because if you just go, I don't think they're any attorney. I mean, but you know, if you start from ground zero, okay, so here's what I want to talk about. Guess what? You're on the clock from ground zero. So, you know, we can start that conversation with your help at about third base. You know, we're going to need to get the plan refined, obviously, but we'll get pretty far down the road and save the client a bunch of money.
Yep, plan design, we do all that. So if someone picks up the phone, they call us, we help them through the entire process. High-level tax, legal, and accounting concerns. We have a advanced consulting staff that's JDs, CPAs,
409 experts, a risk attorney. I mean, we have everyone in-house that makes sure they can speak to our client's specific counsel or anyone they'd like to have those conversations with. Policy review, that's really more probably an honor than it is us, so we do that as well. Document review, that same thing, review documents. Administrative partners, you get my deferred comp plan, I've got people I can call that can help you through that as well.
Best part is our value prop to our clients is if we want to help you do something that is going to perpetuate your business.
So we're not going to charge you anything.
Our hope is that as we help you with that process, you use that.
Tom. Yeah, that's a great point, because, you know, the CFO at the company that we helped is, you know, wants to have really sort of a customized strategy of reporting and statements from the policy. So super good on that end.
Yeah, she's got an actual person.
Great point. And so I think, you know, in sort of closing here, these products, again, one of the messages I hope you've taken away today is that they fit really almost now at any size level, but they also fit really at any sort of business structure. Of course, it goes without saying that every situation is different, but we have clients, and I know you guys have clients in all different kinds of businesses, from construction companies to banks to other types of professional service organizations, you name it. So,
I'll say just kind of a story on a client. We did a buy-sell for him and his wife for
A gentleman that developed a banana ripening oven. So
what? Banana ripening oven. So bananas would come in, they'd be green, they would ripen them, and then they'd send them to the supermarket. So, we'll be just about anything. And they were printing money, I'm not going to lie.
I don't, you know,
I don't know how many of those guys exist
in the country, but we found them. So,
we
are
non, we don't discriminate against
companies we'll deal with.
the only thing we don't do is nonprofits. That's really the only place we don't.
Any other points on the financial?
Kevin talked about the $5 million in revenue, that's about where we like to see it, cash on hand, those are averages, but anything over $1 million. Book value, that's pretty accurate. More like 10 in the value, but that's really where we want to be.
I think that's,
I think the other ones are just.
I think that's it. Just a little bit of, I'll let you toot your horn for 20 seconds.
Like I said, we've been in this space for, we're going on 20 years now. That was from 2016, but last year we had a 32% market share, and that number of 18 million is now over 20. And we work with a lot of the big banks in town, publicly traded entities, but really our focus today is moving downstream and bringing this product and concept closer to our business. We talked about all these different uses of business insurance
From buy-sell planning to key person to ESOPs, Doug, we've talked a lot about that. It's a great use of corporate-owned life insurance, stock redemption plans, all the deferred comp, non-qualified stuff we talked about over here. So I think we've covered that area.
Can you explain the 401k mirror plan?
Sure. Yep. So that was kind of what Hunter was talking about there. 401k mirror would be a company comes to us and says, we have a group of 20 or 30 highly compensated employees that are making $500,000 or more. Those individuals are limited by the limits of qualified planning, how much they can put away, which is $18,500. They want access to put more money away, and they don't have any means in which to do that. So what we're going to do is we're going to set up a non-qualified deferred comp plan that looks just like our 401k.
Okay.
And what we're saying is we will do the same match of the next $18,500 you did in the qualified plan. It's going to have pretty much the same exact investment and fund lineup. So everything that they're doing in the deferred comp plan will look like the 401k plan. And it's a way for companies to take that top tier, say we want to do something ancillary because we know you're maximizing your qualified plan.
And that's not deferrable to the company, but the employee is not realizing that compensation, so they're not paying tax.
So it's a voluntary deferral on my behalf.
That I'm lowering my compensation today, putting it into my deferred compensation plan. At some point down the road, I'll take constructive receipt of that. So a lot of times,
People look at it kind of from the tax arbitrage perspective. If I can get myself down to the next tax bracket, it may be advantageous for me to defer enough money.
yeah, so a lot of times we see it that way as well.
I would add
There are a couple of industries that we see this being used in a lot. And in fact, Bert, we're working with clients now on this. The hospitality space and the food service space. You'll see companies that are run by an executive team, but then have a large population of lower compensated employees. And because of the structure, you got folks up here, a small number of folks making, more money, and a much greater population making much less money at the restaurant or the hotel or whatever. These folks can't put as much away into the 401k plan as they would like to, because these folks may not be putting much in at all. In fact, most of the time they're not, but you can't sort of discriminate in these guys' favor. So it's very common in those industries, Kenny, that we'll implement these plans, and they're very effective in that space.
In theory, you can handpick, but from a carrier perspective,
Typically what we like to see is what we call definition of eligibility. And we'll put something on paper that says these people are eligible, and let's say it's director level and above, making $125,000 or more per year. So if you are director and above and you make above 125, every year you're going to be eligible to participate in the deferred comp plan. So the company will define that. If it is truly one or two people,
we can do that as well. But on a broad-based approach, when you see 20, 30, 40 people participating, it's going to be a hard line of definition of eligibility. Anyone above that can participate. But it's all for the company. The answer is the company gets to choose.
How is and you can invest however you want to do it. And so the company's realizing that the $18,500 thing coming that year. And then once it's vested or once the employee gets received,
Yeah, so they're not gonna vest your own deferral. If you defer your own money, you don't want that to be vested.
right.
Right?
What they're going to vest is that match, or what they call discretionary contribution on your behalf.
Okay.
So if they give you $10,000, they pay vested over 3 years.
Okay. How is it not realized as income to the employee, I mean, based on the trust and then what?
It's a pre-tax deferral, and as Hunter said, these plans are governed by 409A, so they are non-ERISA-based assets.
Right.
And what that means is they're subject to general creditors, and that promise is subject to you as a general creditor.
Okay.
So if the company was to go bankrupt, let's say next year, you lose your 18.5 and you lose that discretionary contribution.
But that is not, the company cannot defer that, I mean, or have to realize that as income.
Correct.
Like, if there's a qualified plan, the company defers it, the employee doesn't realize it as income. And this, the company, when do they get to write it off?
On the back end.
Okay, once they take it, once it's pulled out, actually, by the employer.
Yep.
Once the money's paid out.
Yep, right.
Okay.
Once you get.
So typically, it actually would be a taxable event for the company in the first year, those deferrals.
Yeah.
If you're a pass-through entity, you didn't take receipt of that income, it now goes through my bottom line, I'm not paying tax on it. Yeah. C Corps can book what we call a deferred tax asset,
Mm-hmm.
A little different treatment.
but for the most part, it's going to be a taxable event.
That's a great question.
Like similar 457, I mean.
So 457 would be for a nonprofit,
Right.
same idea. Yep,
All right.
very similar, very same, yeah. But we don't do, like I said, we don't work for nonprofits, but yeah, same idea.
We've done quickly. I got another minute or two. We've done some interesting plans over the years. A very large church comes to mind, who was recruited by another very large church in a different state. We did a plan one time for headmaster of a very, very private school here, who's always there. Those people are always being recruited away. It's a very interesting business. Those guys were already sort of at the top of the pay grade, and the board trustee said, we got to do something to keep these guys around. And they basically said, in fact, the way we got involved in both those transactions was there was a board member who was a member of the board on the church and of the school. And so he really liked the concept. He said, we need to do this for this guy and this guy. And we decided a plan that basically says that the company, not the company, but the church and the school, putting money aside in these policies that they own, that down the road, they say, okay, if you're here 10 years from now, here's your supplemental retirement benefit. And if you want to put some money in the pot too, more the merrier. Glad to have you do it. So it's been a really, in fact, one of those plans now has sort of come to maturity, and it has been a huge success. The guys, it's a big, big part of that particular person's retirement income.
Mm-hmm.
Great strategy. And sure enough, he was there all the way through the contract. Really cool. So I think, Doug, that's it. Is there a question?
I think this on private equity earlier, but how popular has it been with two branch perspective? I know they'll come in and buy a company that have two key owners and they'll drive a lot of revenue to be a relationship or maybe something they know, right? Where they can buy this and have $1,000 cash back in year one versus if I can tell a company 17 years, they do 10-year term policy.
Yeah.
On the law, so they can get. I think it's very popular. I don't know.
Yeah, the answer is it's very mixed depending on the private equity company.
It's really true.
Yeah. A lot of them will look at that as a means in which they're tying up capital that they could put back from an ROI perspective. Others that will keep a business owner on with a 51% stake, they look at that differently. But if it's 100% private equity transaction, they're not there. They're not doing it. So in your experience?
Yeah, I totally agree. I know a large private equity firm here in town who doesn't want anything to do with this stuff, just because at the end of the day, they say, you know what, these portfolio companies, we're not going to get in their hair. All we're doing is investing. We're here for a short while. We're here to maximize what we can in the short run, and we're out of here pretty soon. That's just their philosophy. We've done another project a couple of years ago for a private equity firm that was investing a lot of money in a business that was in Central America, run by the founder who was still operating the company. He's down there sort of working in Honduras, which is I didn't know until then, it was kind of the murder capital of the world. And at the end of the day, they were very darn concerned. This guy had his own full-time security staff and everything, but they're darn concerned. They're putting $50 million in this thing that if something happened to that guy, nobody down there running the plant. And so we insured that guy for $50 million. It was term insurance, but term insurance was a perfect solution for them because they had a sort of a short holding period, but they were just concerned about the guy getting knocked off in Honduras. And so at the end of the day, forgive me because business I'm in every day. but I mean, a really interesting project, and needless to say, difficult underwriting. We had a couple of insurance companies that finally took. Oh yeah, yeah, he's not kidding. And it's interesting because they parted ways. We did that project probably 4 years ago. Sure enough, they parted ways, and in fact, he took some of the insurance with him, and whatever. But it was perfect for the short-term risk. So we're here to help, and we appreciate. And you were going to ask?
Yeah, I mean, I just wanted to. Why would if you are required to have cash on your balance sheet that's used for bonding, what is the downside, or why would a company not utilize something like this versus having cash? Is there some reason that maybe I don't see, or that?
In terms of the actual financial banking, surety impacts, there's no doubt. There's inherent risk in the fact that you're putting life insurance. You're putting money into a life insurance policy that Nationwide could change charges or go to credit rate. Now, there's some products specific to this, but from the actual company and financial insurance impact themselves, there really isn't.
But with no surrender charges, then, I mean, if they did that, you could.
The biggest hurdle I see, and Hunter can probably talk this a little bit, is it's just the commitment to put capital into that vehicle, right? Where instead you could pay $10,000 per term, here you allocating $200,000. So I think a lot of it is just mentality and mindset.
I said it front, and I'll say it again. And the main reason I started off the conversation by saying this is the fact that when the word life insurance comes up, people sort of freak out. They just go, I've heard that's bad stuff. My distant uncle told me don't ever buy a life insurance policy. And that happens at every level. But that's why it's so important to understand that this is not that old school type life insurance policy that quite frankly was pretty beneficial.
I think that can be I think the folks who do it are the sophisticated end of the line. Like they realize, hey, we can pull it out, we can stop it. Why would we make this?
If you look at Nationwide, we have $1.6 billion. We do it ourselves. SunTrust balance sheet 3.2, Wells Fargo 5.7.
Yeah, but SunTrust, don't hurt your feelings, but they've got about $22 billion of cash value life insurance on the book. I mean, they've got it. What your share of it is? Yeah.
I mean, there's the banks, the big institutions do this, and up to literally what the FDIC says that they can do, which is 25% of the
That's an interesting point. The FDIC, a lot of times you'll see in the government. This is another whole conversation, but the government actually has some limits on how much money you can put into a life insurance policy, even an individual, because they say, whoa, you're getting all this tax benefit. We're not going to allow you to buy $1 million policy and put $5 billion in it a year. So there are some standards on that we have to adhere to. But it's interesting. So again, unless there are any other questions, we just really appreciate your interest and time, and we're here to be a resource and would appreciate the chance to be of service.
We appreciate you.
Yeah, and thank you again, Doug.
Before we wrap, since you're here, you're on our list. We've got another program coming up August 30th. We're going to have some claims attorneys come in from Traveler Surety and speak to us about trends in claims and contractual risk that they're seeing. It should be really good. They always put on a very quality show. And I would just tell everybody here, if you are unable, please if you know somebody, a client, somebody who we're not contacting directly that would benefit from coming, please share the invitation. This is kind of an open call. We've got a little bit of a light crowd today, I think maybe because of the summer time that we're in, but
Might have been because it's life insurance.
it might be that bias against life insurance.
Disclosure. I'm realistic.
But this is great stuff. This is definitely something our guys are trying to get, on top of, so that we can be speaking to our clients about it. These guys are great experts, great resources to consult. If you do have situations that you need to explore, please reach out to them. But again, please share your invitation. We can hold a whole bunch more people in this room, and this is a core outreach effort on our part, and it's been very successful. We want to keep it robust, and the Q&A here is really part of the deal, and so having a good crowd every month is really part of the offering. So thanks very much for taking the time to come out.
And real quickly, thank you, Katie, because you helped put all this together. Really appreciate it.
I'm gonna get some. You want to sit down? You're gonna eat too, Hunter? You gonna eat? Are you gonna eat? Yeah. Okay.
Sorry, no. Did I take the one you want in?
No, I'm going to, literally.
My wife went to
Really?
yeah.
Okay. Yeah. Yeah. Absolutely. Because she comes down, Kirsten used to come down and see Mom, right? Yeah. That's right. Gosh, I'm just trying to think the last time I've even seen her. Yeah, me and my wife, we live in Inman Park. We've been here for going on 4 years now. And when I graduated from Finley, I moved to Columbus. I started working at Nationwide, yep, and I've been with Nationwide ever since. Yeah. Hey, nice to meet you. Where do you guys live in town? Okay. Got it. That's awesome. Okay. So I'm the wholesaler. Yeah, and I cover the entire Southeast. So I have Georgia, Florida, North South Carolina, basically Eastern Tennessee, and then Birmingham. So a little bit of everything that touches Georgia. Really? Okay. Yep. Where was his agency?
He was, I don't know which company.